Welcome back to Switzer on Australia's Business Channel. With the stock market succumbing to gravity in recent months, has this meant that our intrinsic value expert Roger Montgomery has a lot more companies that pass his stringent tests? He joins me now. Roger, how are you?
I'm very well, thanks, Peter. In your introduction, you said, there should be a lot more. Yes, there are, and that means what we can afford to do is actually tighten or restrict the criteria even more to the very highest quality companies that are trading at a discount. So what I did is I basically ran a search, and I did it only today, and I went through large caps, mid caps, small caps, micro caps and nano caps. I looked at everything. Right. And I said, okay, I'm going to start the filter really, really wide. Yep. I'm going to narrow it down gradually. Then what I did is I said, I just want A1s and A2s. Yeah, so great. And now that we've had all the results come through, so all the results are in, all our numbers are completely up to date. Yep. They automate. It's all automatic, so it's all done in a matter of a day or so, and everything's up to date. Yep. So those A1s and A2s are as at right now, which is fantastic. And then what I did is I said, okay, well, I'm just going to have a look for companies that our viewers can look at the forecast for themselves. So I said, okay, I'm not going to use the Roger Montgomery forecast. I'll just use companies, I'll look at companies for which there are consensus analyst numbers. Yep. Okay, so what has forecasts? And then what I did is I said, I want companies that have got a return on equity above 20% and a safety margin of more than 10%. So they're trading at more than a 10% discount to intrinsic value, and the intrinsic value is forecast to rise by at least 6% a year for the next 3 years. So lots of criteria here, and they've got a forecast dividend yield of more than 4%. So narrowed that down. So out of 2,100 and whatever companies there are, I narrowed it down to 9 companies. So the first one is a company called Seymour White. Code's SWL. Do you know it?
No, I don't.
Okay, so construction, civil engineering, civil contracting business.
S-E-Y-M-O-U-R?
S-E-Y-M-O-U-R.
White.
W-H-Y-T-E.
Yep.
Now, before you rush out and buy it tomorrow morning, don't. What I like about it is it meets all the criteria. Dividend yield of 6.2%, return on equity of 37%, forecast annual change in intrinsic value based on the intrinsic value model that I use, 22.5% per annum over the next couple of years, which is terrific. Forecast earnings per share growth of 24%, and a net debt to, it's got net cash. Okay. So no net debt.
And what's it do exactly, Simon?
Okay, so it's a civil engineering company, so it's involved in the construction of roads in Queensland predominantly. So the rebuilding of roads because of the flood devastation, all that sort of thing.
Well positioned.
Queensland government has come out and said they're going to spend billions of dollars rebuilding Queensland. Seymour White's ideally positioned to take advantage of that.
And
so
why
I think they're going to do pretty well.
Hesitate?
So the reason I say hesitate is there's been some management changes. So the founder has stepped down and one of the senior directors or even maybe the chief executive officer has stepped down. Not sure why. They've made some statements about, going to pursue personal interests or whatever, but that always...
We might get them on the program.
That would be great. And I'd love to ask a few more questions. Now, the second one, Nick Scarlett. He's got a 5.88%, almost 6% yield, return on equity of 50%, massive return on equity. Forecast annual change in intrinsic value about 16%, earnings per share growth of 7.5%, no net debt, net cash again. Codan, another business that you might not have heard of and your viewers might not have heard of. C-O-D-A-N, the code is C-D-A. They're involved in military and satellite communication equipment, so satellite phones and two-way radios, that sort of thing. And also, I believe it's the biggest, I'm not sure, but I think it's the biggest brand of metal detectors in Australia as well. So they're the distributor of that, if not the manufacturer as well. 6.95% yield, 36% return on equity. Forecast change in intrinsic value is not that much, it's only about 1.5%. Next one, M2 Telecommunications. So we had M2 at the office yesterday for a bit of a one-on-one with the company.
I taught the CEO.
Right,
at University of New South Wales. Yeah, Vaughan.
Okay, so
Vaughan Bowen.
Well, I tell you what, you taught him well because he says.
David Shoothaber taught him as well. All the telco guys.
He says that the company is a sales organisation, and let me tell you, it's in their DNA. I've never seen someone so passionate about their business. And I also think that where they're positioned in terms of not owning a network, not being a competitor to the network operators, 3G and Vodafone and Optus and Telstra, they've got a unique relationship with Telstra. Whether that lasts or not, I don't know, but they do right now.
You think the NBN is going to be good for M2?
Well, nobody really knows, and he was the first one to admit.
Does that worry you, Roger, that that's like an unknown that could affect your intrinsic value calculation?
I spoke to James Spenceley, who's the CEO of Vocus Communications, about a week and a half ago, and he was saying to me he can't see, and he's an expert in the industry, he can't see how they're going to get fibre to every single home in Australia for the cost that they're saying they're going to be able to do it, and be able to charge the price on a monthly basis that they say they're going to be able to charge. He just doesn't think it's feasible. That's his view, not mine. Anyway, 6.5% yield, 33% return on equity, 13% forecast growth in earnings. 13% growth in intrinsic value, 26.5% earnings growth, 18% net debt to equity. Next one is Credit Corp. We've owned Credit Corp now for a while as well. We bought it again. It's an A2 rather than A1, 6.3% dividend yield, 22% return on equity, 8% forecast increase in intrinsic value over the next few years, trading a very good discount to intrinsic value based on my estimates, and 18.5% earnings growth. The next one is Breville Group. Breville, 6.14%. Everyone knows the brand. Breville, 21% return on equity, 6.5% increase forecast for intrinsic value, and 21.5% earnings growth forecast. Next one, GR Engineering, which is a mining services contracting business, a business that only floated recently. To much fanfare. A lot of my peers in funds management were eager to get some stock in the flow of that. It did very well. It's an A2, 4.6% dividend yield, 93% return on equity. I don't think that'll last, but nevertheless. Forecast increase in intrinsic value, 6.3%. Earnings growth of about 3%. Again, no debt. And the last one, Flight Centre. An A2, 5% dividend yield, 25% return on equity, 6% increase in intrinsic value forecast, 3.5% growth, and again, no net debt.
How has Flight Centre continued to defy the critics? You must have worked it out by now.
Do you know what my answer to that question is? Isn't it fantastic that nobody's been able to work it out? The reason why is if you can't work it out, they may just have a sustainable competitive advantage. The best thing, I always say to people, the assets that aren't on the balance sheet are the key assets. It's the things that you can't go to Germany to buy. You can't go and buy that bit of machinery and replicate your competitor. That's the real source of competitive advantage. Sometimes I've met with companies where the competitor has said, we don't know how they do it, but they keep doing it.
Well, here's my
and what that tells me is it's not replicable.
Yeah, that's right. Well, are these stocks that you think that have long-term value as well?
I've got a view that because Australia only has 22 million people, it's very, very hard to find businesses that have truly sustainable competitive advantages that are going to last 30, 40 years. We don't have the Coca-Colas and the Nestle's and the Johnson & Johnsons. We don't have those in Australia. And so it's important that if you are going to manage your own portfolio, that you manage it, that you're involved. And I also see, we talked about cycles. I see a cycle in people's investing patterns as well. We've got baby boomers now. They're all thinking of retirement. They're all interested in managing their own superannuation because they're not happy with how their broker has done or their advisor has done. So they've got time when they retire, they've got money, and they're interested in learning new things. So it strikes me that there's going to be a very real trend towards stock market education and that sort of thing. But in 20 years' time, when those investors aren't 55 and 65, but they're 75 and 80, I think they'll be tired of looking at their computer and they'll revert back to looking for a fund manager to do the work for them because, hey, they want to see their grandkids, they want to get out more, they don't want to be tied to their computer screen investing their own money. At all times, this idea of blue chips, it's a mistake. There are some companies that are described as defensive, they're described as blue chip, and they're absolute rubbish. The companies like Amcor, and it's not an investment candidate. Qantas is another one, widely described in the past as blue chip, and people would come up to me and say, you're talking about Qantas badly, they pay me a good dividend. Guess what? They stop their dividend because they haven't got the cash flow. So don't fall into the trap of believing that big means good.
Okay, Roger, thanks for that very much.